For the jobs number, the final number before the election came in far below estimates. 12,000 jobs added in October, the lowest number since December of 2020. Breaking down some of those numbers for us here at Post 9 today is Goldman Sachs chief economist Jan Hatzius. Jan, happy Friday. As always, good to have you.
Same to you. Good to be back.
What's the best way for a viewer to understand this print?
I think it's a very noisy number. We knew that there was likely to be a negative strike effect and a negative hurricane effect going in. The number came in well below the estimates, but there also seems to have been potentially a bigger hurricane effect. We thought that Helene was going to weigh on payrolls by something like 40 to 50,000. But if I look at the note from the Labor Department, it seems like Milton also might have had an effect because they noted the evacuations around Milton. So it's very hard to know. I mean, even with that, it might be a little bit weaker. And the household survey was also a bit weaker. And the Labor Department said that that wasn't really affected. But I wouldn't put a lot of weight on it. It's also a very low response rate in the establishment survey. So you have to take these numbers with a big grain of salt. Just like I think you had to take the 254,000 that was reported a month ago with a significant grain of salt. I think the labor market's still doing well. And the trend is high, materially higher than this. And the unemployment rate seems to have stabilized in the low fours, which is a pretty good place to be.
Was it surprising that BLS said we can't put a number on storms? Would you expect them to?
I don't think they really have the information yet, because this is going to really depend more on the state and local numbers. They will publish state and local numbers, and then I think we'll have a better sense. Oftentimes, they note these things qualitatively without putting a specific number on it.
For a Fed that's data dependent, when the data is coming in so lumpy, what does that mean for next week's meeting? The rates complex seems to be acting kind of like steady as she goes. Do you agree with that?
Yes, I think the expectation going into this was already that they were very likely going to cut by 25 basis points next week. And of course, that's being reinforced. But there's not really anything very new there. At the margin, you might get a slightly more dovish message in terms of what happens at subsequent meetings. We've been expecting another cut at the December meeting. And, at the margin, I feel maybe a little bit more confident about that. But again, I wouldn't put too much weight on today's number.
How would you characterize the moderating contribution of immigration, as you describe it, and its role in that 4.1% unemployment rate?
Well, I think the increase in the unemployment rate from the 3.5% range that we had, a year and a half ago was in part driven by a large influx of less skilled workers that are unemployed at slightly higher rates, at least in the early years, and also compete with the less skilled parts of the native-born workforce. It takes a while to absorb all of those people in the labor market. So I think that's the main driver. The other point to keep in mind is that because of this immigration, which was so strong a year ago and seems to have come down a lot, it's harder to estimate what the break-even rate of payroll growth is that keeps the unemployment rate unchanged. So it adds further to the uncertainty that I just noted.
The president made a point of mentioning the 2-1 print on PCE this week. And you wrote a report almost a year ago pondering whether inflation could fall below target. Where are you on that discussion, do you think?
Well, we're at 2.1% on headline PCE. We're at 2.7% on core PCE. So, I think over the last year, we've gotten a moderation, a little bit less of a moderation than we thought a year ago. Most of the upside surprise was really concentrated in the first half of the year, but we have made a lot of progress. And I think we'll continue to make progress, because if I look at, for example, the labor market indicators, the supply-demand balance, job openings, quits, wage growth, I think all of those suggest that the deceleration is still ongoing. My expectation is we'll be at about 2 by the end of next year. But over the next couple of years, could we be a little below 2 for a period? Yes, but I wouldn't expect a big undershoot because, the U.S. economy is still very strong.
Much has been made about this being the last print before the election next week, of course. How would you characterize what we're seeing with this lumpy with this lumpy month of data versus what it indicates about how Americans are feeling about the economy right now?
Well, I think a lot of the economic indicators have performed better than I think most people, certainly the consensus of forecasters, thought over the last couple of years. Inflation has come down a lot, and that has happened with above expectations GDP growth, strong employment growth, still a strong labor market. But consumers also look at the cumulative increase in prices, not just the year-to-year inflation rate. And if you look at, a lot of the surveys, they still say prices are up a lot. So it's still a mixed picture. If you look at the consumer sentiment and confidence indices and you adjust them for some noise and some breaks in the data, in the University of Michigan, for example, there have been some changes in sample design. You do see an upward trend in these sentiment and confidence measures, but maybe not to the degree that you might expect if you just looked at the year-over-year inflation numbers and the employment numbers. So it's still a mixed picture, I think, the way that consumers are looking at this.
A lot to absorb, especially today, Jan. Thanks for helping us, as always. Thank you.
Thank you.
Jan Hatzius.